It's the beginning of April, which tends to be one of the hottest months for new listings and buyer demand. So are mortgage rates gonna help or hurt buyer demand this month of April? We're gonna look at mortgage rates, where they've been, where they're going, and what the experts are saying.
I keep it real, I keep it real, I keep it real, just keep it real.
Hey, what's up guys? It's Sam Hartman, keeping it real estate here in Fort Wayne, Indiana. And as always, I come to you to bring context and clarity to real estate headlines so that you can be a highly informed and confident consumer when it comes to making great real estate decisions. If you're new to my channel, make sure you like and subscribe so you see future videos. And if you're returning to my channel, let me know in the comments what types of videos and content you like to see, or let me know a question you might have that I can answer in a future video. And so with that being said, let's get into mortgage rates and how they might be looking to either help or hurt the real estate market in this month of April, which, like I said in the intro, tends to be the hottest month for new listings to hit the market, but also buyer demand, especially that week coming out after spring break, when all the spring breakers get back and kids get back into school. People tend to really put their home search into high gear at that point. And we'll lead it off with a quick review of what mortgage rates have done this last week with a quote from Sam Qatar, chief economist with Freddie Mac. Mortgage rates dropped slightly lower this week, providing a bit more room in the budgets of prospective home buyers. Additionally, encouraging data out on existing home sales reflects improving inventory. Regardless, rates still remain elevated near 7% as markets watch for signs of cooling inflation, hoping that rates will come down even further. So in past videos, I've gone over projections with interest rates, and a lot of projections were very optimistic that rates were gonna be in a much lower trajectory at this point in the year. And I was not so optimistic. I actually expected the Fed to be more conservative with lowering rates, which is exactly what we're seeing. And that's not necessarily a bad thing. The Fed is trying to get inflation well under control before they start easing on their monetary policy. And the fact of the matter is the job market has remained extremely strong and the economy has remained extremely strong. So with those two things in line, those could lead to more spending, which could lead to more economic growth, which the government sees as possibly leading to more inflation. So the Fed has been reserved, has been a little more conservative with their policy, and that's not necessarily a bad thing, although I know a lot of home buyers out there are really hoping, praying, and crossing their fingers that we start seeing some of that relief sooner rather than later. But we'll talk about that more later in this video, about what we're looking at, new projections, new expectations, and everything coming down our way. So where have rates been since the start of the year? And they've really been fluctuating in this upper 6 to low 7 range, depending on which estimates and indicators you're looking at. And so right now, interest rates are sitting right at about 6.8. I've seen some averages even being in the low 7%. And I want to highlight here at this point, because I see a lot of different measurements on any given day as to what the average interest rate is. This is why it is so vitally important to get this financial information up front during your home search. One, it's important to be pre-approved, but two, it's important to shop your lender. Don't just hop online and fill out an online application with a big national rocket ship bank or fast mortgage or anything like that. It's probably best, one, to either reach out to me and get recommendations from my trusted lenders, but to work with someone local that's gonna have a personal touch to it, walk you through the costs associated with the loan, as well as I think it's important to have multiple options here, because you shopping your interest rate could get you a lower interest rate. And I think that is gonna be huge for affordability and home ownership, the lower we can get that interest rate. So shopping around, considering your options is really important to make sure that you're getting the best interest rate possible during your home search. So I know it's kind of confusing where I talk about the Fed and interest rates and policy, monetary policy, and to a lot of consumers that might feel really overwhelming, feel really confusing. So I've got a great quote from NerdWallet that kind of explains a little bit more about how interest rates are affected and overall established, more or less. And so this quote starts with, the Federal Reserve influences mortgage rates, but they don't set them. At its March 20th meeting, the central bank kept Fed funds rate unchanged and said it will keep an eye on economic developments to decide what its next rate move will be. So the Federal Reserve sets what's called the 10-year Treasury yield rate, and the 30-year interest rate, the mortgage rate, tends to be associated with that rate. So as that rate rises, the mortgage rate tends to rise. As that rate falls, the mortgage rate tends to fall. But there are other things that affect the mortgage rates. So mortgage rates are influenced by many elements, including the inflation rate, the pace of job creation, and whether the economy is growing or shrinking. The Federal Reserve's monetary policy is a factor and is set by the Federal Open Market Committee, also known as the FOMC. And that quote's from NerdWallet. So I hope that helps explain a little bit. It's not as exact of a science, but we do have indicators that we look at and that we can kind of see coming down the pipeline whether interest rates might be looking to go up or down based off of some of those leading indicators that we see in advance. And so we talk about that Federal Reserve, the FOMC, and really what they said at their latest meeting is they're deciding to maintain their target range. They're not cutting rates, they're not raising rates. They're looking to keep that range the same at about 5.25% to 5.5%. So that keeps rates unchanged, but that doesn't mean that interest rates won't change. If we continue to get positive inflation data, if the jobs data takes a hit where there's more jobless claims, sadly some of these negative things like people losing their jobs would actually be beneficial for the interest rates. So these aren't things that we necessarily like to see in the economy, but as we kind of are looking at the burden and the bear that we've had with interest rates, certainly that is one of the aspects that could lead to improving interest rates as well. But at this time, even though the Fed said that they plan to make 3 to 4 interest rate cuts this year, at this time, all the way through the first quarter, going into second quarter, they are still holding rates steady, not making any cuts or any planned cuts at this time. So when will cuts start to come? And I've got a quote here from Forbes. Current expectations are that the Fed will start to cut rates at some point between June and September. So really in the second half of the year. The exact timing depends on how incoming economic data looks, the inflation data, the jobs data, the economic data, things like that. The Fed's March meeting did not set up the prospect of a near-term interest rate cut, but summer cuts appear likely. So what that means is instead of kicking back, sitting by the pool and relaxing all summer, I'm probably gonna be busting my butt with a lot of buyers as hopefully interest rates continue to improve throughout the summer. But my advice is don't wait for interest rates to improve. Start your process, start your info gathering, figure out what you can afford today. And if that works for you, if you can get a house that you would like and enjoy and be comfortable in at today's interest rates, any improved interest rate after that helps your affordability. You can always potentially refinance into a lower mortgage rate. I just met with a young couple. They're in their early 20s, maybe mid 20s, and it was a great first time buyer consultation. And I just loved the conversation because they were so realistic about the house that they wanted and needed. They're so eager to get out of apartment living, but also they were just so frugal and so really just matter of fact about what they wanted to spend. And they looked at today's interest rate, they've talked to a lender, they really gathered the information and made a really informed decision about where they want their budget to be. And so I just love those meetings that buyers are so realistic and open to gathering the information to make an informed decision. And I love being a part of that conversation. So don't be afraid of finding out that information. Maybe what you find is, yes, you do need interest rates to get lower before you can buy a home. But now you have that information. Now you know for sure, and now you can plan more specifically for your hunt in the future. And so I talked about those coming rate cuts and the economic data that plays into that. But Freddie Mac has a quote here kind of pointing to some of the challenges with why rate cuts haven't happened yet, and some of the challenges with that economic data. And they say, while we expect inflation to eventually moderate in the short run, a growing economy is keeping inflation above the 2% target level. The Federal Reserve is trying to get inflation to 2% or below, but due to the strength of our economy right now, it just hasn't gotten there. It's just still staying at under 3%, but still above 2%. It's hard to get to that kind of last final stretch. Therefore, we expect the Federal Reserve not to cut rates until summer at the earliest, and potential upside surprises on inflation could push rate cuts even further back. So what they're saying there is, if we get economic data, we get that inflation data that says, ooh, inflation's starting to bump back up, the Reserve is going to continue to be conservative. They're going to continue to push rate cuts further back, and we might see these elevated interest rates even further into the back half of the year. Rates might be more on the upper 6.5% to 7% range. And so if buying a home in 2024 is something that's on your to-do list, like I said, plan for that 7% range, plan for rates today, and we'll hope that rates improve your affordability in the future and that we can take advantage of that. But we're not going to let that dictate our decisions and our actions here right now in today's market. And that's exactly what Freddie Mac also says here in their next quote. As a result, Treasury yields will remain elevated in the near term, keeping mortgage rates elevated. We forecast mortgage rates to stay above 6.5% through this quarter and into the next. So that is Freddie Mac's projections, but let's look at some of the rest of 2024 projections from a couple other entities, which we have here: Fannie Mae, the Mortgage Bankers Association, and the National Association of Realtors. So here we've got a little bit varying, a little bit discrepancy between each, but really they're all pretty close, in lockstep with each other as far as projected rates. And now these rates have been updated as of March of this year. So here we have on the average of all three for quarter one, 6.77%, quarter two, 6.63%, quarter three, 6.4%, and quarter four, 6.2%. So getting down below that 6.5 point will really be great, but also these projections have changed over time. At the start of the year, a lot of the projections were expecting us to be below 6% interest rates by the end of 2024. And so due to the continued elevated inflation data, the continued positive economic data, and the Federal Reserve's monetary policy to hold tight and be conservative, is pushing some of these projections a bit higher and expecting rates to be a little higher for a little longer. So it might take us a little longer to get below 6%. Again, back to my advice of starting now, planning for today's rates, and if rates improve in the future, boom, we can help take care and take advantage of that affordability at that time. And so Jerome Powell, he's the chair of the Federal Reserve. He made a comment during an interview the other day where he said that he does not expect interest rates to get back to the 2019 levels. Now, 2019 is what we would have maybe considered our last normal market before the COVID years took over. That's when the interest rates got down below 3% and money was cheap and free and easy and flowing into the housing market and into the economy across the board. But before those COVID year interest rates, those were in the 4 to 4.5 range. And so what he's saying is he does not expect those interest rates really to ever get back down to that level. I think if we get down into an interest rate starting with a 5 and can hold that for a period of time and can kind of hold strong economically and in the housing market, that is a huge boost to buyers. But we really shouldn't hope and pray and have our fingers crossed for the rates to return for the pre-pandemic levels or even during the pandemic levels, because let's be honest, those low interest rates is what has led to this high level inflation that the government is now working and scrambling like crazy to get their hands around. As much as it would be great to buy a home with a 3% interest rate again, the economic fallout is going to be just as or more damaging as it would be helpful in terms of buying a house. So Jerome Powell said himself, he does not ever expect those interest rates to get down back to that 4.5% level. But hey, if we can get them down going into 2025, starting with a 5%, 5.8, 5.9, I don't really care, even a low 6, I think that's going to be a huge boon and huge boost for buyers out there. One thing I like to talk about with prospective buyers and their search and how it correlates to interest rates is the longer you wait, the more you hope for interest rates to get lower. Guess what? Other buyers are also thinking the same thing. And here's an awesome graph that kind of shows and portrays that sentiment, how buyer demand reacts to interest rates. So at above 7% interest rates, buyer demand tends to be pretty weak. Between 6.5% to 7%, the buyer demand is a bit limited, but as interest rates continue to drop, we get below that 6.5%. If we get down to that 6% level, that is when buyer demand is really going to start to strengthen, and we're going to start to see competitiveness come back to the real estate market in a lot of different ways. There's already competitiveness at the lower price point, the entry-level price point for buyers. I listed a home recently for $225. That's a pretty affordable price point for our market. We received 6 offers and accepted an offer for $250, so $25,000 above the asking price. Exciting for my seller, but at the same time, that's 1 out of 5 buyers that got the house that they wanted, and that's disappointing. I've been on that side of things before. I've helped buyers that didn't get the home that they really wanted and were excited about. So again, my advice for you is to, start the fact finding, start the info gathering now and in today's interest rate, and figure out, can you make it happen in today's market at today's interest rate? And any reduction in rates going forward into the future, you can take advantage of the affordability then at that point with a refinance as well. So to that point, I've got a quote from Lawrence Yun, who's the chief economist with the National Association of Realtors, where he says housing demand is on a steady rise due to population growth and job growth. Basically, we've got more people and more people have jobs that allows them the opportunity to afford housing. Though the actual timing of purchases will be determined by prevailing mortgage rates and wider inventory choices. So we do see positive effects on inventory growing, although still in Fort Wayne's market, we're still extremely limited, but we are seeing a little bit of extra inventory this year compared to last, which last year was just a horrible, horrible year in terms of inventory, in terms of just general activity being slow and down, but we still saw price appreciation last year. So a really unique dynamic that we saw inventory low and we saw demand low, but we still saw strong price appreciation gains of over 7% in our market. So with all that being said, again, my advice is the same. Start the process sooner. Get the information sooner. Be an informed consumer. And if you have questions, reach out to me so I can help answer them and help you find the right questions to ask and find the right information to gather so that you can find out, is home ownership a reality for you? And I want to finish here with a couple different graphs that are really showing that there's still a strong appetite and desire to own a home. And here it shows that 40% of consumers expect to buy a home in the next year. Leading the way is Gen Z, saying 63% of Gen Z hopes to buy a home over the next year, 59% of millennials, 45% of Gen X, and 21% of baby boomers. So what those numbers tell me is Gen Z is that first-time buyer market. They haven't bought a house yet. They're living with mom and dad. They're trying to get out of their apartment. They're sick and tired of throwing money away. They want to start building their wealth. So a big swath of Gen Z is really chomping at the bit to buy a home and get into the market. 59% of millennials, this market, the millennial generation, could be getting into the first-time home buyer, but they're probably also in the move-up situation. So they're considering, should we trade in our lower interest rate because our family is growing? Maybe we're getting separated or divorced. Maybe we've got a job relocation, or maybe we've been promoted and have more income that we want to buy a house that better fits our lifestyle. So that might be more of what the millennial generation has fallen into, which is why almost 60% of them expect to make a move over the next year. Gen X, a little bit older now than the millennials, might be kind of settled in, getting their kids through high school, through college before they're really making another move. And of course, the baby boomers, they've made their money in real estate. They've got their low interest rate. They've bought their house cash. They don't have a mortgage. They're sitting pretty. They've got only 21% of baby boomers expecting to make a move over the next year. And I think this is a really good statistic because I've heard and seen some headlines that talk about a silver tsunami of real estate listings hitting the market. And that silver tsunami, sorry mom and dad, but it's referencing you and your silver hair. But it's saying that this older growing baby boomer population is going to start unloading their family homes, the homes that they raised their families in, the homes that they have been in for a long time. And this stat just kind of shows me no such wave is coming. There's not a lot of desire from the baby boomer generation to move. They're pretty comfortable. They're on a fixed income now in retirement. They want to keep their payment low. So that is a big reason why that baby boomer generation just doesn't have the appetite to unload their properties and to make a move in today's market. And so this survey goes on to further ask those consumers what interest rate they would deem worthy or consider making a move for. And so this actually shows a higher tolerance for higher interest rates now based off of this survey. So Gen Z shows that their average current interest rate is 5.4% for those that own a home, but they would consider interest rates up to 6.3%. Now we still got a ways to go to get there, but they would consider a 6.3% interest rate to trade in that lower rate for. Millennials would consider 6.2%, Gen X 5.8%, and those baby boomers 5%. So again, those baby boomers are looking pretty locked in because we really don't expect rates to get down that low. But the 6.3, the 6.2, the 5.8, all of these kind of metrics that this survey is showing tells me that as interest rates get lower, we really could see a large infusion of buyer demand into the market as we approach those low 6s, high 5% interest rates. So again, if you don't want to be fighting other buyers for properties, if you want to be able to make a purchasing decision with a little bit more time, a little bit more comfort, a little bit more education and process to the purchase, then you're better off starting now, because as those rates get better, big swaths of these generational buyers are going to start coming to the market, and that's going to be competition for those homes. And so to summarize, I think Duncan's quote, the chief economist with Fannie Mae, really kind of sums up this whole conversation pretty well and where we're at as far as the housing market and interest rates. And he says the housing market is likely to continue to face dual affordability constraints of high home prices and elevated interest rates in 2024. Hotter than expected inflation data and strong payroll numbers are likely to apply more upward pressure to the mortgage rates this year than we previously forecasted, as markets continue to evolve their expectations of future monetary policy. Still, while we don't expect a dramatic surge in the supply of homes for sale, we do anticipate an increase in the level of market transactions relative to 2023, even if mortgage rates stay the same. So in 2023, Doug kind of points to this. Our market was down about 20% in transactions, although it was up over 7% in overall prices. So even though we saw reduced transactions in 2023, and we're seeing kind of similar dynamics at the first quarter of 2024, we're already seeing more transactions getting done. We're seeing buyers getting frustrated with waiting. We're seeing sellers getting frustrated with waiting, and they're just making things happen now. They're stepping out, they're taking the next steps, and they're pursuing the next stages of life. So again, if you've been frustrated by the market, if you've been frustrated by interest rates, if you own your home and you don't know what to do, reach out to me, let me know, because especially current homeowners that are looking to make a move, whether that be a downsize or a relocation or possibly even a divorce, there's a lot of reasons that it makes sense to make a move, even with higher interest rates. And one of the things I love helping sellers with is determining the creative ways that we can find to make your move as smooth and as comfortable as possible. A lot of sellers don't know the options that are available to them, but you do have a lot of options to utilize the equity in your home and make your move as comfortable and smooth as possible when it's right for you. So I'd love to share more information about that with you as home sellers and home buyers out there. I want to start the conversation as early as you're ready for the process. My advice is start as soon as it becomes a consideration. You know, to have a conversation with me, there's really no cost and commitment. I just want to provide information, be a helpful resource to you. And if you're finding these videos helpful, I think I can do that for you on a personal level with a personal consultation as well. So don't hesitate to reach out and schedule an appointment, because that is truly what I'm here for. That is truly what I love to do and value doing. I love to be of value to my clients and to my community. So just let me offer that to you. I hope this video was helpful, guys. We're going to continue to monitor mortgage rates. We're going to continue to bring updates as it pertains to mortgage rates in our real estate market. So if you found this video helpful, if you know someone that could benefit from this information, like it, comment, share this video with a friend. Thank you for staying with me, and keep it real estate out there.
I keep it real, just keep it real.